Welcome to the session on equity options. My name is Doug Carroll, and it will be my pleasure to do a brief presentation of an introductory nature on equity options. The session will be just under an hour in length, and given the brevity of the time slot, most of the session will be focused on basic concepts and terminology. Although I'll try to make sure that there is a little time towards the end of the session to focus a little bit on trading applications. So without further ado, let's begin the discussion of equity options. Here you see a slide of exposure profiles that indicate the potential gains and losses over various price ranges of the related equity security. The middle panels on each side are positions that would relate to being long or short the security itself or a futures contract on that security or index. And just to be clear for those not familiar with these sorts of diagrams, the vertical axis indicates the amount of gain by displacement above and loss by displacement below the horizontal axis. If you end up right on the horizontal axis, the position is broken even. And the horizontal axis itself represents the level of the price of the related security or commodity, oftentimes referred to as the underlying. And this diagram assumes increasing prices of the related security moving to the right. Now, with positions in the underlying, whether long or short, you'll note the diagrams indicate symmetric gain-loss profiles. Increasing gains the farther the market moves in favor of your position, increasing losses the farther the market moves against your position. On the other hand, if you look at the four corner panels where the four basic option positions are shown, long call, long put, short call, and short put, you'll note options have asymmetric gain-loss profiles. On one side of the crosshatch, now in this case the crosshatch in the middle represents the price at which, the strike price of the option. On one side, the in-the-money side of the diagram, there's a range of prices of the underlying that would show increasing gains to the long or increasing losses to the short. On the other hand, on the opposite side of the strike price, there's a range of prices of the related security or commodity where the losses to the buyer are constant, and by the same token, the gains to the short or writer are constant as well. That's where the option is out of the money and it would not be exercised. Now, I'm not going to focus on the diagrams in detail now. I was mostly trying to give a sense of the implications or the insights that could be drawn from them. But one thing that might be worth noting now, and this is sort of a general guideline I would give regarding trying to understand options. Note, if we look at the long call and short call diagram, if those diagrams were rotated around the horizontal axis, you'll note they're mirror images of one another. To complicate things even to a greater degree, compare the long call and the long put diagram. If one were to draw an imaginary axis through the strike price, again, if one rotates the diagram of the long call around that imaginary axis drawn through the strike price, you have a diagram equal to the long put. In other words, each of the four basic option positions has two mirror images. For those new to options, imagine trying to grasp the concepts by holding an understanding purely based on words, where every situation you're trying to describe in words has two mirror images. Point being, the words tend to be very confusing. So in general, I would minimize or suggest minimizing your reliance upon the words and focus more on the charts and diagrams and the like. They convey the information a lot more cleanly and succinctly. Of course, some word descriptions have to be, some word definitions have to be committed to memory. You need to know a call is an option to buy and a put is an option to sell. So that's unavoidable to some degree. But to the extent possible, I would suggest, until one is already comfortable with options, minimizing the reliance on the words and, again, concentrating on the charts, diagrams, and even bullet point lists, because they convey the information a lot more cleanly and succinctly than do voluminous word definitions or descriptions, especially because in every case there'll be two mirror images of whatever is being described. So over-reliance on words is a recipe more for confusion than clarity when trying to first get a good grasp of options. So let's introduce option contracts, and we'll go through the contracts in some detail. If you saw the introductory session on derivatives, we identified the two main categories of derivatives: forward commitment contracts and contingent claims, and options were in that latter category. And the contingency, of course, relates to whether the owner of the option decides to exercise their right to do something, to buy if it's a call, to sell if it's a put. And naturally, the writer has an obligation, but note they will only have to live up to that obligation should the owner of the contract decide to exercise their rights. And indeed, that's what leads to the asymmetric gain-loss profiles we were looking at on the previous slide. In fact, just to backtrack for a moment, where the option is out of the money, the owner is not going to exercise it. They'd only exercise it if the option is in the money. And therein lies the contingency referenced by the name contingent claim. The session is only going to focus on simple call and put options, what are sometimes called plain vanilla. Not that they're simple contracts, they're just the simplest of all options. Exotic options are extremely complex instruments that have many moving parts, as it were, and are way beyond the scope of this discussion, although they are also contingent claims. For the moment, all we'll do is note that there are such things as exotic options, but not even try to provide a basic description, because there are myriad types of exotics with so many different features. We would have a hard time simply listing all the names, much less trying to describe them in the short time we have together. So what we're going to do is work through a basic example of a long call. And in fact, I'll spend most of the first half of the session or so talking about long call options in detail. And then by analogy, describe short calls, long puts, and short puts. The idea being that by focusing on one in detail, it will give you a chance to get a greater depth of understanding, and then we can discuss how the other three basic types, the three other basic option positions, are similar to or different from the long call options, which we would have talked about in detail. But in the context of the discussion, we're talking about puts and calls, so those are the only two types of options, and we'll discuss how they're designated. And all options relate to some related security or commodity or currency, the underlying asset as it's known here, and not just some general reference to it, a specific number of units, par value of bonds, number of British pounds, or in the case of the equity options, we'll talk about number of shares, as well as a price at which the owner of the option has the right to exercise, and some length of time, because options are what are sometimes referred to as wasting assets. That is, they will cease to exist at some point in time. And it's not like a bond where at maturity the bond is worth its par value. Options are worth nothing at expiration if they're out of the money. If they're in the money, they're worth, well, what's known as the intrinsic value, and that's a term we'll have to define in some detail going forward. Before we get into a discussion of the option contract itself, a little bit of terminology is necessary. Note near the top of the page, there are a variety of terms that are used interchangeably with one another. So the term long, buyer, holder, and owner are all completely synonymous with one another. They're completely interchangeable. And each of those terms refer to the person who has paid a premium to establish a position in the options market. In other words, they paid the premium to have the right to do something, to buy if it's a call, to sell if it's a put. Now, note I was careful to say paid a premium to establish a position, because if one initiates a position by selling, they might hold that contract until it gets exercised or it expires, or they might decide to close out that short position early. And were they to do that, they'd pay a premium to buy back the option they had sold. That situation would not be described as long, buyer, holder, or owner, because if one bought back a pre-existing short position to liquidate it, there would be no position in the market. So I want to be careful to emphasize that these terms apply to those who've paid a premium to initiate a position. And the potential confusion comes into play because authors or speakers, not wanting to sound overly monotonous, will change the words they're using to refer to the same party. So if you were reading a passage in a book or chapter on options, they might talk about the buyer of the option. A sentence or two later, they'll talk about the holder or the owner of the option. A few sentences after that, they'll talk about the long option position. Well, guess what? In each instance, they're referring to the same party or the same position, simply changing the words to make the words less monotonous. So it's careful to realize those terms are completely interchangeable with one another. And once one owns an option, they have the right but no obligation to exercise. So unlike the forward commitment contracts that were talked about both in the introductory session and the interest rate swaps talked about last week, those forward commitment contracts obligate both parties to the contract to do something. On the other hand, with a true option, the holder has the right to exercise but is under no obligation to do so. And note, it's that right without an obligation that results in the situation we saw a few pages previously, where when the option contract is out of the money, and you might remember that that is on the side of the strike price where we see a range of prices of the related asset at which there is a constant loss to the buyer, that at all prices at or below the strike price at expiration for long call options. Well, if the option is out of the money, that might mean, for instance, where the strike price, the right at which the owner of the call had the right to buy, was 50, and the related stock was trading at, say, only 38 or something like that. Well, who in their right mind would want to pay 50 for something the market said was only worth 38? Consequently, the owner of that call would not want to exercise it. They'd simply let it expire. And that is one of the attractive features of options, that as long as one acts rationally, i.e. as long as one doesn't exercise an option when it's out of the money, one never has to lose more than the premium paid. So let's look at a particular option contract and go through the elements of the contract in detail. And here's a recitation of the terms of the option contract. In fact, let's look at this in a little bit of detail. My computer is pausing for a second while we get out there. Okay, so let's look at both the terms of the option contract and slide number 5 now. And the terms are there in words in what is now slide number 5. But let's look at it in the context of an actual contract. And indeed, this is not simply a made-up contract. There is such a contract out there trading this very day. So remember earlier we said all options, there'll be a designation as to the type of option, and we're only talking about the plain vanilla puts and calls. So generally there will be a clear designation as to what type of option is being discussed or what one might have an opportunity to trade. So the letter C are the word call for call options. The letter P or the word put for put options is the typical designations. On the other hand, there are some information sources where the convention is if it's a call option or if it's a put option, there'll be a clear designation. If there is not a clear designation as to what type of option is, the presumption is it is a put option. That, for instance, is the convention that had been used on Bloomberg for options on futures. If one were to have called up a Bloomberg page on, say, December T-bond options, December being the month of expiration, there would be two columns of numbers down the page that indicated strike prices. The column of numbers to the right, to the left would just be numbers. The column of numbers to the left would be followed by the letter P. So there was a clear designation as to what strike prices related to put options. Where there was no designation, the assumption was that it was a call option. So that is a fairly common convention. If there is no designation, one should assume it's a call. Of course, if there is money or professional reputation at risk, you want to be certain, you don't want to guess. I'm simply sharing with you what is a common convention. And note, this contract we're discussing we're assuming one is buying, that is going long. And we're starting here because generally from many decades of teaching experience, people generally tend to be more easily able to understand options that give one the right to buy, that is the long call options, which is why we're going to look at them in some detail. Now, beyond the type of option and what position one has, the contract will have various features. Now, note on the previous page at the bottom, the previous slide at the bottom, it makes the distinction between exchange traded and over-the-counter. Both types of options will have similar terms. The difference is in who establishes those terms. You'll note behind exchange traded, and anytime you see the word listed, that's code word for listed for trading on an exchange. So you can always assume that when some derivative is described as a listed or some security is described as listed, it means exchange traded. And for derivatives, at least, they'll refer to listed derivatives as standardized. In other words, in general, the exchange where the contract is traded is what will be the entity that determines the contract terms. For standardized derivatives, exchange traded options and futures, the only thing the buyer and seller negotiate is the price at which they're going to trade the contract they've agreed to exchange. All of the other terms are standardized, that is, they're set by the exchange where the contract is traded. On the other hand, in the over-the-counter market, the buyer and seller of the trade negotiate all the terms. So not only do they determine the price at which they'll trade the option, but they'll decide the number of units of the underlying, the strike price, the expiration date. Concepts I've mentioned, which I haven't described in detail. Those are the contract terms we're going to talk about in detail as we go through the Google option on the next slide. But the point being is that if it's an exchange traded option, the only thing the buyer and seller agree on is the price. All the other terms are set by the exchange. If it's an over-the-counter option, the buyer and seller negotiate all terms of the transaction, not simply the price, but all the terms of the option contract as well. So let's look at the call option that's illustrated on slide number 6 and as shown on the screen currently. So aside from the type of option that the counterparties have agreed to trade, and we're looking at it from the buyer's perspective, obviously one of the crucial elements is what sort of related security or commodity does the buyer or seller, are they trying to get exposure to? In this case, what we're talking about is options on Google shares. Of course, the company's official name is now Alphabet, but they're still using the old ticker symbol. So GOOG is the ticker symbol for Alphabet common stock, although again, people typically still refer to the company as Google. Now that's the underlying asset, and again, the underlying asset doesn't have to be equities. It could be commodities, it could be futures contracts, it can be swaps, it can be currencies. But other than mentioning the wide range of things that one can trade options on, we're going to focus in detail on equity options because I believe they're the easiest to understand. But it's not just Google shares, it's some number of Google shares. And this is where the standardization or negotiation comes in. In general, for exchange-traded options, unless the company had declared a stock split since that series of options started trading, the standardized number of shares is always 100 shares of the named stock. Now again, that's unless the company had declared a stock split, because naturally if a company declares a 2-for-1 split, they've doubled the number of shares outstanding. Option contract terms will have to adjust to reflect that change in the company's capital structure. And maybe an interesting topic, but it's a little bit beyond the scope of what we're going to talk about today, to discuss the different ways that exchange-traded options will be adjusted for the happenstance of a stock split. Now, if it's an over-the-counter option, the contract can be for whatever number of shares the buyer and seller agree. It could be 500, it could be 575, it could be 1,312.625. You might wonder how you end up with 0.625 shares. Well, there's any number of ways one can end up with fractional shares, but especially if one is involved in what's known as a DRIP program, a dividend reinvestment program. That is where you're electing to get shares rather than the cash dividend the company declared, and oftentimes that results in the issuance of fractional shares. Going forward, I'll assume that what we're talking about is an exchange-traded option, which we'll talk about in a number of pricing scenarios in one of the subsequent slides, although I will mention some issues that come up in the context of negotiated or over-the-counter options as part of the discussion. So since this is a call option on Google shares, the owner of the call, the long, has the right to buy 100 shares of Google common stock, since we're assuming this is an exchange-traded or listed option. The price at which the owner of the call has the right to buy those shares is what's known as the strike price, also the exercise price. In this example, that's $940 per share. Options are always expressed per unit of the underlying. If this was an option on, say, £1,000,000 British pounds, the strike price would be in dollars, say, and that would express the amount of dollars you'd have to pay for each of the £1,000,000. In this example, since the strike price is $9.40, that's $9.40 a share on each of the 100 shares. So it's $940 on each of the 100 shares that this option entitles the holder of the listed call to buy. In other words, the holder of the call would have to pay $94,000 if they decided to exercise that option. Now, since this is a call, the owner has the right to buy, since they're long, 100 shares of Google, since that's the named stock on the standardized option, at the strike price of $940 a share. But as indicated earlier, that right doesn't exist forever. It exists only until the option expires. And so what you see is the expiration date, also referred to as the expiry. That's just shorthand for expiration. And it's not just a day. They expire at a certain time on a specific day. Again, that level of detail is beyond the scope of the discussion, but generally options expire on Fridays, and it's that evening that the options would expire. So this option gives the holder the right to buy 100 shares of Google at $9.40 a share until October 20th of 2017. And again, if they exercise the right to buy the 100 shares at $9.40 a share, they've got to pay $94,000. Now, all of those things that we just discussed, the type of option, the underlying asset, the strike price, and the expiration, those are the terms of the contract that the buyer bought one of. And in general, once the contract is created, the terms don't change. The only exceptions to that are one I'd mentioned already. The terms of the contract will be adjusted for stock splits. And for over-the-counter options, the strike price will be adjusted for cash dividends. In fact, the strike price will be reduced by the amount of the cash dividend. So Google doesn't pay a dividend, but let's say Google initiated a dividend and paid $5 a share at the next dividend date. That strike price would typically drop from $9.40 to $9.35 if it was an over-the-counter option. On the other hand, exchange-traded options, they do not adjust the strike price for cash dividends. But with those exceptions that I've just mentioned, once created, the terms of the contract are fixed. However, the value the market places on the contract is likely to change. And that price of the option is typically referred to as the premium. That is the market price of the option. And like the strike price, the premium is expressed as an amount per unit of the underlying. So since we're assuming this is a listed equity option, which would be for 100 shares of the named stock, that $19 premium would mean $19 a share or $1,900 to buy the contract. Now, of course, once one buys the contract, their cost basis is fixed. However, the value the market places on that contract is likely to change over time. And let's get into the factors that impact the value of an option. So there you see the contract we just discussed. What are the factors that influence the price of the underlying asset? Well, in other words, to talk about it in a somewhat formal sense, what we're going to talk about are the option value determinants, or saying the same thing another way, the option pricing model inputs. So if one was running a binomial pricing model or even a Black-Scholes model, these are the factors that one would have to establish values for and input them into the model to estimate the fair value. Now you'll note on this page I've just identified 6 factors, although we're subdividing them into several groupings, which we'll discuss as part of the ensuing presentation. And all equity option models will have either 5 or 6 variables for which one would need values to input into the model. It is not a function of whether you prefer the 5 or 6 variable model, it's a function of the underlying shares. If the underlying shares pay a dividend, the dividend yield will have to be one of the values input into the model. As it turns out, since Google does not pay a dividend, we would only need 5 variables for which we would need to get values to estimate the fair value of the option. Were I to have chosen Apple Corporation stock for the example, well, Apple pays a dividend, so we'd need a 6th variable, we'd need a dividend. But the 5 variables we'd need to run a pricing model, Black-Scholes or binomial, and for what it's worth, Black-Scholes is not widely used for pricing options. That's because Black-Scholes makes assumptions not consistent with many real-world options. Black-Scholes is designed for European style, i.e. no early exercise, we'll talk about that later, on non-dividend paying stocks. So those assumptions are not consistent with most options, and consequently Black-Scholes is not widely used for valuing equity options. On the other hand, Black-Scholes, and really more formally Black-Scholes-Merton, is widely used, but its primary use is for calculating the Greeks, the sensitivities of options to changes in these variables we're about to discuss. So what are the 5 variables? Well, one is the market price of the underlying stock, and another is the strike price of the option, the price which the owner has the right to buy or sell. Now, while there are 3 additional inputs we'll need to value the Google option in question, let's stop at the first 2 for the moment, because by comparing the market price of the stock to the strike price of the option, what we're finding is the option's intrinsic value. Now, that is by far the most widely used word. On the other hand, I prefer an alternate word that you will encounter with some frequency in the options business, and that is moneyness. Now, that is not a word one would find in a typical English dictionary, although one might find it in a financial dictionary. And it will become clearer why I prefer moneyness to intrinsic value later on, but there are different ways of referring to the same thing. But the reason I prefer moneyness is because options that are at or out of the money, terms that I will define in detail in a few moments, by definition, at or out of the money options have zero intrinsic value. Nonetheless, options that are at or close to the money with a long time to expiration might still be extremely valuable. And yet, by definition, at or out of the money options, no matter how much time is left to expiration, would have an intrinsic value of zero. And as we'll see, moneyness, how close or how far in or out of the money the option is, has a significant impact on an option's value. So ergo my preference for moneyness, but more about that later. But an option that's not yet expired or has not yet been exercised will have some time value in addition to the intrinsic value, and time value is a function of the other three factors: time to expiration, interest rates, and volatility. Now, you'll note the way I've set this up, and it's not my idea, this is pretty standard in the options business. By implication, there's a formula, which we'll see on the subsequent page. By implication, and this is a formula, this is a formula one would typically see in every introductory level options book. That is that the premium, the premium of the option is the sum of the option's intrinsic value plus its time value. Now again, remember, the premium is the market price of the option, and it's the option value determinants that we looked at on the previous page that are presumably the factors that are driving option market participants to place a higher or lower value on the option. But it's important to realize that this formula, while it is in every introductory level book on options I've ever seen, it is something that provides almost zero insight into understanding option valuation. On the other hand, that's not to say you don't need to understand this terminology if you want to understand options, because this is widely used jargon, and so it's necessary to have a sense of the implications of the jargon. And as is true of much jargon, especially the jargon can be confusing in many cases, and that is especially true in the case of time value. But let's look at what insights we might get from this formula and try to get a handle on the jargon before proceeding with the example. So, well, let's define here. Let's take a look at the formula that we saw before, and I'll backtrack over the pages that we just went through. And we'll talk about the formula that you see here, and these are numbers consistent with the option contract we saw previously. So remember earlier I said that all options, well, I made reference to the terms in and out of the money. Well, you'll note all options exist in one of three states of nature. They are either in the money, at the money, or out of the money. Now, there are word definitions which I'll give you for that terminology, but I strongly suggest this is one of the places where the word definitions are more confusing than helpful. So in a previous life, I was an exam prep trainer, and I got literally thousands of people through the Series 7 exam, the exam one has to pass to become a stockbroker to be able to discuss investments with their clients. And I would arm them with a number of diagrams when they were about to sit for the Series 7 exam, this being one of them. So you'll note this diagram is well, it starts out with a cross that splits a field into 4 quadrants with plus signs and minus signs in the 4 quadrants as indicated. So plus signs northwest and southeast, minus signs southwest and northeast. And you want to have calls and puts above the 2 sides of the diagram. And remember to put it down right, puts above the right-hand side of the diagram. Now, when you end up in a quadrant with a plus sign, that tells you the option is in the money. End up in a quadrant with a minus sign, that tells you the option is out of the money. And the significance of in or out of the money is, well, in part, it relates to this intrinsic value we're about to discuss. But also, remember earlier I talked about owners of options would only exercise an option when it's in the money. In other words, if an option is out of the money, it would be irrational to exercise because one would end up losing more money than they would otherwise have to. So first, how to use the diagram, or I should say the way you use the diagram is, again, recognize if it's in the money, you'd exercise it rather than let it expire. If it's out of the money, you'd rather let the option expire than exercise it. So let me show how to use the diagram, and then while doing that, discuss or give you the definitions of in or out of the money. When's an option in the money? Well, an option's in the money when the market price is better than the strike price. And the confounding thing is, what's better is different depending upon whether it's a call or a put. Calls are in the money when the market price is above the strike price. Puts are in the money when the market price is below the strike price. So you'll note change one word from above to below, it changes the definition from an in-the-money call to an in-the-money put. Conversely, when's an option out of the money? Well, an option is out of the money when the market price is worse than a strike price. And again, what's worse depends upon whether it's a call or a put. Calls are out of the money when the market's below the strike. Puts are out of the money when the market's above the strike. You'll note the definition of an in-the-money call is the same as the definition of an out-of-the-money put. Now, why am I going through this in detail? Well, because to understand intrinsic value, you'll note the definition of intrinsic value is shown at the top of the page. Intrinsic value is defined as the difference between the market price of the underlying and the strike price of the option if the option is in the money. Now, of course, if you focus on the words, that's not a definition, it's really a formula. It's the formula for computing the intrinsic value of the option. I'll put this in the context of the option contract we were just discussing, and then we'll come back to a more meaningful definition of intrinsic value. So here you see the same diagram with the numbers from our option contract superimposed on the diagram. The strike price of our call from several slides previously was $9.40. So that's the first thing you do is establish what's the level of the strike. Then you have to determine whether the market price is above or below the strike. Market price above puts you in the top half of the diagram. Market price below puts you in the bottom half of the diagram. So in our example, since compared to the $9.40 strike price, the market price of Google, several slides previously, I didn't focus on it at the time, but it is shown on that slide if you care to look back, was $9.44. So markets above strike puts us in the top half of the diagram. Since the call we go to the left, plus sign tells us the option is in the money. And remember how we got here, we're trying to define intrinsic value. And the definition, again, really a formula, was that if the option is in the money, the intrinsic value is the difference between the market price and the strike price. Ergo, we have an intrinsic value of 4. Now, we'll look at that in the context of the option premium, but what is the real meaning of intrinsic value? Well, that's given at the bottom of the page. It's the net cash flows the holder of the option would realize if they exercise the option and immediately liquidate any resulting position in the underlying stock. In other words, if I exercise my right to buy at $9.40 and then immediately sell at $9.44, I'd pocket $4 a share. Now note, I came nowhere close to calling that a profit because if we had previously paid a 19-point premium, we'd be looking at a significant loss. On the other hand, sometime after the option was purchased, the premium is a sunk cost. So going forward, one has to decide from today onward, does it make sense to exercise or not? And if we were at the moment of expiration, it would make sense to exercise this option rather than let it expire, because you're going to get back at least $4 of the dollars you had paid to buy the option originally. Now, put this back in the context of the option premium. The total premium that we started out with was a premium of 19. We've just determined that the intrinsic value is 4. By plugging, we would find that the time value of the option was 15. I guarantee you this is the only way that formula can be used. There is no option pricing model in the world, and I teach courses on option pricing models that estimates the time value and then estimates the intrinsic value and adds them together to get the premium. Oh, you might see a book of an introductory nature on options that's playing memory games and says if the time value is 3 and the intrinsic value is 7, what's the premium? Well, the answer to that is 10. But that's not how you'd be able to use this formula in the real world. What you always have to start with is the premium, because that's either the output of your model or it's the observable market price of the stock. You can calculate the intrinsic value because that's simply a mechanical relationship between the market price and the strike price. And by plugging, we find what's called the time value. And unfortunately, time value is a really grossly misleading bit of jargon. Because guess what time value would have been called was given a name that was a descriptor. Because calling it time value creates untold confusion because it makes people think that somehow timed expiration is the primary driver of this thing called time value, and changes in the passage of time to expiration are likely to be the biggest drivers of change in this thing called time value. Almost nothing could be further from the truth. The big drivers of time value are changes in volatility and changes in moneyness. Remember moneyness from earlier. Because all options with the same timed expiration do not have the same time value. The options closest to expiration, the options with underlying prices options with strikes closest to the current market price of the stock will have the highest time value. And options with strike prices farther and farther away from the current market price, whether you're talking about options farther in or out of the money, they'll have less and less time value even though they all have the same timed expiration. So calling this thing time value creates untold confusion for people first trying to understand options. The literal meaning of time value, well, think of how we just calculated it. It's the portion of premium that isn't intrinsic value. That's the only thing this thing called time value really means. And if you want to have a sort of an intuitive understanding, think of it as an uncertainty premium, in the sense that which options have the greatest uncertainty about whether they'll be worth something at expiration or not? Naturally, options with strikes equal to the current market price have the greatest uncertainty because you don't know whether prices will go up or down. Whereas for options already deep in or deep out of the money, they're likely to still be in that general situation by the time you reach expiration. A brief illustration of these ideas in context. The following page shows, a little bit of terminology first. We won't have time to discuss these positions in detail, but understand just like there was a number of synonymous terms to describe the position of the buyer, there are similarly a bunch of terms used interchangeably to describe the position of the seller. If you're the terms short, writer, seller, and less commonly but occasionally grantor, because the writer has granted the right to do something to somebody else, the buyer of the option. All those terms are interchangeably used to describe the position of the person who has received a premium when initiating a position. You get that premium to compensate you for the right you're granting to the buyer of the option. Briefly, just a couple of price scenarios we want to go through to look at gains and losses under different circumstances. So let's look at the situation. And here's the long call diagram in general terms that shows limited loss to the downside and increasing gains to the upside. And in fact, let's look at this diagram while we're also working through the following examples in a little bit of detail. So let me get out of presentation mode here. It doesn't want to let me out of presentation mode. I guess we'll not get out of presentation mode. You'll have to refer back to that example on your own. So here's the contract we started out with earlier. Let's look at 4 pricing scenarios, that is different prices of Google, And this is the same contract we looked at earlier that we introduced in detail. Long one Google 940 call expiring on the 20th of October. And there's today's date when Google's at 944. What happens if by October 20th, the last day of trading, Google's at 925? Well, of course, that would mean that the option that gives you the right to buy at 940 would be out of the money. It isn't very valuable to have the right to buy something at 940 if the current market value of the thing you can buy at 940 is only 925. Consequently, we'd let the option expire and lose the premium. But note, whether Google dropped to 925 or 850 or 700, the owner of the call would never have to lose more than that $1,900. Again, that's one of the big attractions of options, is one never has to lose more than the premium paid, as long as one acts rationally and doesn't exercise an out-of-the-money option. Well, let's consider a second scenario. What happens if between today and October 20th, Google were to have risen to 967? Well, of course, if Google was up at 967, if Google was up at 967, the 940 call would be in the money. And consequently, rather than let it expire, the owner would exercise the right to buy at 940. They're acquiring for 940. Stock the market says is worth 967. Thus, they just bought the stock for $27 less than the market says it's worth. Now, that 27 wouldn't be a profit, because remember, the only reason the owner of the call had the right to buy at 940 was because they previously paid the premium of 19, which means that after netting the premium paid against the gain at exercise, the owner of the call would have realized an $8 a share profit. Now note, that would be true if they exercised the option at its expiration on the last day of October 20th. But what would happen if, say, Google rose that much by this coming Friday, by September 15th? Could they exercise the option? Well, the answer is yes, because exchange-traded options in the United States are generally American style. And note, I earlier referenced European style. Realize American and European style, those terms have no geographic significance whatsoever. They are purely references to when one could exercise. American style options are exercisable anytime. European style options are exercisable only at expiration. So since this is a listed option in the United States, that means it is American style, which means even though September 15th is about 5 weeks prior to expiration, the owner of the call could still exercise. Note, by the way, that would generate exactly the same profit of $8 a share. Now, of course, one would rather make $8 a share, $800 a contract over the next 3 days, as opposed to the next 6 weeks practically. But that's not the point of the comment. The point of the comment is simply, it doesn't matter when you exercise. If you exercise an option, all you earn is the intrinsic value. So let's look at the scenario in the bottom panel. This assumes, again, that by September 15th, Google has traded to 967. Now, that's 5 weeks, 35 days prior to expiration. But there is another way out of the option besides exercising it. In fact, the way most profits on valuable calls is realized is not through exercise, but through a closing sale. So the option contract we originally purchased for 19, there's a abbreviation of the contract that was identified at the top of the page that we talked about in detail earlier. And this is the analysis of the premium at the time we bought it that we discussed in a little bit of detail earlier as well. Well, that's on September 12th when Google is at 944. What about now that it's September 15th with Google at 967? Well, I've done an approximation here, but I'm assuming that with Google at 967, it's not an assumption. That means the intrinsic value would be exactly 27. And I'm assuming a time value of 8, which leads to a premium of 35. Now, note that one might think, well, gee, that had to hurt, because in general, anytime one sees a decline in something that they own, that's generally not a good thing. So if the time value has declined from 15 to only 8, despite the fact that only 3 trading sessions lapsed, one would think that had to be a negative from the standpoint of the buyer. But note, if we bought the option at 19 on Tuesday, today, and could sell it this coming Friday at 35, note we would have had a profit of $16 a share compared to making a profit of only $8 a share had we exercised on September 15th. How come the owner of the call is making more money by doing the closing sale as opposed to exercising the option? Well, note, when you exercise an option, all you make is the intrinsic value. When you sell an option, you get the entire premium, the time value plus the intrinsic value. So that's why I said earlier that in general, profitable call options are generally not going to have the profit realized by exercise. You'll generally realize the profit by doing a closing sale. Because early exercise of an option, in a sense, results in throwing away the time value. And of course, in general, it never makes sense to throw away something of value. You'd always much rather capture as much value as possible. Well, unfortunately, time is growing short here, so I don't really have time to work through the balance of the presentation in detail. Just to show you what's there, there's brief descriptions of long put options and the formulas for showing the potential gains and losses, as well as a brief description of both short calls and short puts. And then the last several pages, this page is just a summary of the direction of price change of the underlying that would benefit any party in one of those 4 basic positions. And note those arrows imply the change in value only related to those 4 basic options. Naturally, if one was doing a strategy that entailed multiple positions, like I'm long the stock and I sell a call against it, what's known as a covered call, I'd not necessarily want the price of the underlying to go down. That would hurt the value of the stock I'm long, despite the fact it would be helping the value of the call that I'm short. And the last several pages work through in detail both a covered call, that is where one is long the stock and is selling the call as a way of generating additional income when one probably has a neutral market view going forward. And there's a worked out example showing break-even points, maximum gain, and maximum loss on a covered call position. As well as the last few pages deal with the purchase of a protective put, where one is long the stock and is buying puts to protect against a downside move in the underlying stock. And again, a position that shows the diagrams of the constituent parts as well as the net of the position. And again, a worked out number example showing break-even points, maximum gains, and maximum losses. And should you have a question related to any of the content, please feel free to get a hold of me through Starweaver. So I will hope that those participating or subsequent viewers find the session a little bit helpful in terms of bringing a little bit of understanding to the basics of options. And for those participating now, I'd be happy to take questions if there are any questions, but I'll wrap up the presentation there for now.